Now, if you are viewing this video right now, you may have heard of ARK Invest, or you have already invested in one of ARK's funds such as ARKK or ARKG. Now, ARK Invest has recently came into the news for the wrong reasons. Their flagship fund ARKK, ARK Innovation ETF, has actually seen massive outflows of $456 million. Secondly, some people have actually flagged up that ARK Invest ETFs invest with illiquid assets, which means they could face liquidity issues once things turn sour. Now, is ARK Invest in any trouble? I can give you a quick answer right away. Absolutely no. But moving forward, there could be potential problems, which is what I want to try to help you understand. Now, in this video, I'll be addressing two key parts. The first, I'll give you a history on ARK Invest. I'll show you their growth story as well as their direction moving forward. The second part, I've actually crunched out numbers regarding this liquidity issue that I'd like to share with you so you become a more informed investor. So with that, let's roll in the intro video. Hi guys, welcome back. Now at the start of the video, I actually mentioned that ARKK, which is the flagship fund, has seen 456 million outflows. Now 456 million seems like a huge number, correct? But actually, let me show you this chart over here, which is actually the inflow. ARKK actually saw record inflows in some weeks, crossing $1 billion. That means actually $456 million, while it's big, it's not substantially big that will cripple the fund immediately. So do not panic about it. It's like 50% that came in actually went out. These things can happen to any fund itself. Now, let me show you also the growth trajectory of why ARK's funds are so popular. And this is actually the AUM growth of his flagship funds. Let's focus on the first two, which is the core of today's tutorial, ARKK and ARKG. ARKK is the purple line that you see over there. And in the span of 1 year since 2020's pandemic, they've actually grown their asset under management by almost 20 times, now at a 21 billion asset under management. The second most popular fund is actually ARKG, which many YouTubers have covered already. They've seen growth also about almost 20 times, and right now they are about $9 billion in terms of asset under management. I'd like to also get you to focus. ARKG as well as ARK Next Generation Internet used to go hand in hand in terms of the growth rate, but ARKG has actually seen a substantial spike in terms of popularity. And a key reason can be attributed to Cathie Wood's marketing efforts and bringing more people to be aware of the potential of genomics. And let me show you a quick example of how things work.
We actually think the next fangs are in the genomic age. And if you'll notice our flagship portfolio, the largest exposure is healthcare.
Now, you may be thinking, why are ARK's funds so popular? It can actually be explained with performance. And let me show you the chart over here. The first one, ARKK, which is the flagship fund, ARK Innovation. And what we can see in 2020, they delivered a staggering 152% rate of return. Now that's fantastic. What about ARKG? It's delivered 100.5% in terms of return, which means if you put $10,000, right now you're sitting at almost $20,000. If we compare these two funds with, for example, the S&P 500 as well as QQQ, which focuses on technology, NASDAQ, you realize that these two funds have outperformed their peers tremendously, especially in 2020. That is why so many YouTubers, and that's why so many in the forums have actually suggested that Cathie Wood has indeed cracked the secret wisdom of how to invest successfully. Now, with such performance in 2020, ARKK's 5-year annualized return is 45% per annum. What about for ARKG? It's clocking in at close to 37% per year over the last 5 years. Now, you may be thinking, 2020 was spectacular, correct? But what about for 2016 all the way to 2019? Was it doing better than most indexes? Was it really that spectacular? I've actually numbers for you. In comparison again to QQQ, which focuses on NASDAQ, as well as VOO, which focuses on S&P 500. And what I can show you over here is ARKK in 2015 to 2019 was also better than these two funds. It clocked in an annualized return of almost 26%. What about for ARKG? It clocked in almost 14% from 2015 to 2019. That placed it third when we compare across these other indexes. So there's a few conclusions we can make. Active fund management can indeed work and can work better than passive investing strategies. It's also no wonder that Cathie Wood is known to be not a fan of index investing.
We think there are 35 to 40% of the S&P will be considered a value trap over time.
Now this also shows that ARK is a skilled investor, because even excluding 2020, it's done fantastically over a 5-6 year time frame. Now you may know that Tesla is actually ARK's top holding right now. By further information to show the history of ARK's funds so that you know deeper what this team has been delivering to investors. Let me show you the fact sheet that I've managed to dig up for 2016. At that point of time, ARK was focused a lot on 3D printing. It was his top allocation at 14%. Gene therapy, something that Cathie Wood is very hyped up about now, is at 3% only. Now if we flash a comparison between 2016 and current allocations, we'll realize that 3D printing has dropped in terms of allocation from 14% to only 6%. But gene therapy, which is something that they believe is the future, has inched up significantly from 3% all the way to 8.9%. What about for ARKG? In 2016, you realize that these are some of his top holdings: Illumina, Athena Health, Foundation Medicine, and Vitae Corp. But for 2020's top 10 holdings, you realize that it has been totally changed. The only name that resembles from what is looking like in 2016 is only Invitae Corp. Right now, the top 3 holdings for ARKG is Pacific Bioscience, Teladoc, and CRISP Therapeutics. So there's a few conclusions that we can quickly make. The active fund manager has done significant changes over the time on its portfolio. And the second part is that copy trading is not so easy. If you have been tracking, for example, ARK's movements and buy sells, you realize that they've actually morphed their allocations quite significantly over years, which takes a lot of effort if you like to mimic some of their trades. And I'd like to actually draw some attention to Athena Health, which is a very interesting story. As you can see, in 2016, it was actually ARKG's second highest allocation, 9.4%. But this company has actually got into trouble, as I can show you in this chart over here. You realize that its stock price plunged, and it was eventually acquired by another competitor. It goes to show that when it comes to investing, there can be some allocation missteps, and ARK is also no exception to things. But mainly it's how they've allocated significantly to other portions once they have made certain mistakes. And I've also another interesting finding on Tesla to share with you also. Tesla was actually already on ARK's top 10 holdings. It was number 2 allocation at 9%, which means ARK's conviction on Tesla has actually been very strong for many years. I was always suspecting whether they've actually came onto Tesla only in the recent few years, but doing this research, I actually realized that they have maintained a consistent communication that they believe in Tesla and they believe they have a lead in terms of the electric vehicle space. And let me share with you a quick roundup from their webinar in 2017.
Most people think of Tesla as an electric vehicle company, but ARK sees it as an autonomous taxi service provider.
Now, if you have benefited, smash the like button because it's taken our team more than 10 hours of research into this very interesting topic. So hopefully you've benefited from it. Now let's move on to the second part of things, which is actually data points on liquidity for ARKK and ARKG that you should be aware of, and which companies that they own are at risk of liquidity issues, especially if you are looking to mimic some of their buy and sell trades. Let me flash back the article by Reuters, which actually mentions that ARK actually has a far bigger problem because they own more than 15% in a handful of companies whose shares are relatively illiquid and potentially hard to exit when redemptions surge. These names include Compugen and Stratasys. Now I've actually done some number crunching and let me show you some details. The first one, I would like to actually start this portion by focusing on their top holdings. In ARKG, these are its top holdings. The first one is Pacific Biosciences, and what you can see over there is indeed the total number of shares held by ARKG and ARKK is significant. What about for CRISP Therapeutics, also on the top 10 list? You can actually see that there's significant holdings between, again, ARKK and ARKG. The same goes for Twist Bioscience. ARKK and ARKG own significant percentages. What about for non-top 10 names? Compugen was something flagged up by Reuters, and indeed, if you see in those allocation, double digits, especially for ARK ETF. ARKG also owns a portion of Compugen. What about for Syros Pharmaceuticals? You also realize significant percentages held, and also Sirius Corp. There is indeed valid reasons as to why liquidity could be a major risk when it comes to these two ETFs itself. And I've actually done a compilation thinking through how much they've owned versus how much average trading volume. I've actually come up with this number of days to sell their holdings. I simply use the number of shares they have to divide by the total average liquidity that is shown by these companies, and this is to show you ARKK. Indeed, there are few companies that they own that it's going to take very long if they would like to dispose that allocation away. What about for ARKG? You realize that it looks to be even worse. They hold significant percentages in many firms. It's going to take them more than a few days to sell out from some of these positions itself. I'd like to show you a summary of things which we have done as a team to crunch out these numbers for you. You realize that the number of days to sell is significant for many companies between ARKK and ARKG. In a lot of ways, these two funds are rising in popularity together. If anything were to happen in terms of negative sentiment, you also realize that both of these funds will see outflows and they'll be competing for liquidity. Which means if you add on the days to sell for ARKK and ARKG, some of them will indeed take more than 15 days to exit, which is quite a horrific number of days. There are a few conclusions I'd like to share with you. The first thing, as we know, short sellers are there in the market. Hedge funds are there. That's why the GameStop saga. And right now, ARK being so popular, it actually has a target on its back that many hedge funds may be looking to prey on. And let me share with you something also mentioned by Reuters. As you can see, the pressure on this fund this week has lured in short sellers with 100% of ARK's innovation for shorting out on loan. This short selling pressure can cause the ETF to trade below its net asset value, which leads to redemptions as ETF arbitrages exchange the fund for the underlying holdings and then sell the underlying holdings, exacerbating the selling pressure on these ETFs. Another report has also showed that ARK's liquidity, ETFs unlike hedge funds do not have long-term capital and can rapidly gain or lose assets based on sentiments of its retail investors. Now, ARK's information is fully transparent online. If you can see it, you can bet that actually hedge fund managers are looking closely to see how they can profit and exacerbate downturns, especially for some of its holdings, and front run them if they have the capability to do so. There's another conclusion I'd like to share with you is copy trading when it comes to some of their small cap allocations can actually be very dangerous. As I've shared with you, it may take more than 15 days for them to exit a position, and that means if you are also invested in one of their smaller cap names such as CompuGen, you realize that if you would like to sell, it's going to be very difficult. So think about this issue. I think we have to raise a possibility, which is when it comes to crunch time, ARK may need to liquidate some of its more liquid holdings, such as in Tesla, such as in Square, such as in Roku, which have very good liquidity ratios. Now, this does not mean that they have lost conviction. It could simply be a force of hand if they were to face significant outflows. $456 million did not cause a dent, but what if it's more than $1 billion? What if it's more than $1.5 billion? Then you should see that some of their trades could be forced out of liquidity issues. So hopefully this has given you a very good sensing of ARK's story as well as some of its risks moving forward. They are a very popular fund for a good reason. They are a fund manager that has done really well, but also with things being so transparent, they have now a target back on their back. They've actually invested in a lot of small illiquid firms that have benefited with their growth story. And when things reverse, you should expect it to be also looking harder than most other indexes itself. So if you have benefited, also inviting you to press on the subscribe because I'll be launching a subsequent video on ARK to show you that actually ARK's investment is actually not as unique as you may think it is. So if you're curious on that topic, press on subscribe, get notified when I release it in a couple of weeks time. We're rounding up research on it. Again, thank you for watching till here. I'll see you in a future video. Take care and goodbye.